Hi, I'm Brooks Zachary with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary as a basis for this market update. So let's jump right in and take a look at the market action last week. Here we had the S&P 500 up 0.7%, the Canadian stock market up 0.1%. There were two large driving forces in the market last week. The first one being the Consumer Price Index release on Wednesday. That came in at 5.4% on an annual basis. And on a month-over-month basis, we saw 0.5%. These are actually very high numbers for inflation, but they came in as expected. There was some concern in the markets from investors that the numbers were going to come in even higher. And when the numbers came in as expected, we did see the markets stabilize and actually move higher from there. Last week, we did see the Senate pass a bipartisan $1 trillion spending package, and with the focus on infrastructure. That helped the metals and mining sector and the material sector move higher for the week. So we saw some of the cyclical sectors rally. And now we are seeing the Democrats talk about coming up with another $3.5 trillion spending package for a long-term basis. And that's going to be a little bit hard to pass, just given that there's been a passage of this from the Senate on a $1 trillion package. But nevertheless, the government's still trying to spend more money down the road. If we take a look at HAC last week, we did see HAC trim its position in the biotech sector. The biotech sector has been performing a little bit behind the market. It's been lagging the market recently, and HAC did reduce its position there, and it used that allocation to increase in its utilities sector position, which has actually been performing well recently. If we take a look what's happening in the markets right now, we can see here that the S&P 500 is up 0.7% last week. Now, last week we did see interest rates overall. Now, I'll go through this in a second, but we did see interest rates go up and then come back down and close lower for the week. But look at the growth sectors of the market that typically benefit from lower interest rates. They all were positive, but they underperformed the S&P 500. If we take a look at the material sector performed very well. Industrials outperformed the market as well. Financials performed well. Energy was down. So 3 out of the 4 growth sectors I've got here, or I should say cyclical sectors, did quite well last week. It's interesting to see that the consumer staples sector actually performed very well last week, as well as the utility sector as well. Healthcare was positive, but a little bit behind the market. So we saw the cyclical sectors generally perform well, and the defensive sectors perform well in the market last week, despite falling interest rates not helping the growth sectors. And if we take a look at the yield here, so this is Monday, Tuesday, Wednesday, Thursday, and this is Friday here. So this is the close of the week before for the U.S. 10-year Treasury note yield. And we can see here that it actually closed at 1.29%. So overall for the week, it was lower. We did see the yield rising here, and this was a concern with the whole CPI numbers. Maybe they were going to be higher than the consensus was at the time. There's some fear around that. But once the CPI numbers came out, we did see, in this case, and this is Wednesday here, we did see the yield go up on Thursday, and then actually come down on Friday quite strongly here. Why am I showing you the yield on the 10-year Treasury note? Well, I think that investors now are going to be taking a look at some of the macro factors, like the what's happening with interest rates, what's happening with the U.S. dollar. And the reason being is we're largely through the earnings season for Q2. Yes, we do have some earnings coming out this week. We've got Home Depot, we've got Walmart, we've got other companies as well. But we're largely through the earnings season. And if we take a look at some of the economic reports, the big economic reports have already passed through their cycle. There's always economic reports coming out on most days during the month. And this week we do see the retail sales on a month-over-month basis coming out, with the FOMC meeting minutes coming out as well. But it's not some really big driving economic numbers that investors really focus on to drive the market in either direction coming out this week. So investors are going to be looking for other clues and what's happening in some of the macro components, such as interest rate movements. Usually at this time of the year, we do see the yield on the 10-year Treasury note declining on a seasonal basis. And it'll be interesting to see if that does happen at this time, and what that might mean for the market. So the declining yield from a bond perspective, the bond investors would be anticipating either lower inflation expectations or slower growth going forward as well. And that actually, if it's a slower growth aspect, we could actually see that actually come back and put downward pressure on the market as well. So it's going to be interesting to see what happens this week, particularly with the yield on the 10-year Treasury note. That's something that I think is worthwhile following at this point. Thank you very much for joining me today.